for BCom Honors, BCom General, CMA Inter, and CA Inter students. Topic Depreciation. Join online class with Dr. Subrata Mukherjee. Datta and Company purchased a machine for rupees 50,000 on 1st January 2015. On 1st June, it purchased another machine for rupees 30,000. On 1st March 2016, Datta and Company sold the second machine purchased on 1st June 2015 for rupees 25,000, and on the same day purchased another machine for rupees 27,000. Datta and Company calculated depreciation at 20% under the diminishing balance method. The accounts for the business were closed every year on 31st December. So the machinery account for the 2 years ending 31st December 2015 and 31st December 2016. So any problem of depreciation, working is very important. So in my earlier video, I have mentioned that whenever you solve a problem on depreciation, you have to identify two things. One, the accounting period. It may be the financial year or it can be your calendar year. In this problem, the accounting period is the calendar year and the method of charging depreciation is diminishing balance method. So I'm doing the working force first. And this working is very important because when you will prepare the ledger for this machinery, it will be just putting the values that you are writing here in the working. So the first machine was purchased on 1st January 2015 and I term it as M1. So M1 was purchased on, here I am writing the particulars. So M1 was purchased on 1st January 2015. So the cost of M1 is rupees 50,000. So again on 1st June 2015, another machine was purchased for rupees 30,000. So I term it as M2. This is rupees 30,000. So there is no more transaction during 2015. So on 31st December 2015, I'm going to charge depreciation at the rate 20% on diminishing balance method. So on M1, this will be 10,000 rupees and on M2, this will be 3,500. How I arrived at 10,000? Say 50,000 into 20% will give you rupees 10,000, and on 30,000, that is the cost of machine of M2 into 20% into 7 by 12. So this will give you 3,500. Since the machine was purchased on 1st June 2015, so I have charged depreciation for 7 months. So the written down value on 1st January 2016 it will be 40,000 for M1 and 26,500 for M2. Now on 1st March 2016, M2 was sold. So you need to charge depreciation for 2 months. So less depreciation. So here I am also writing less depreciation at the rate of 20% for 2 months will be 883. So how I arrived at this figure? 26,500, which is the written down value, into 20% into 2 by 12. So this will be rupees 883. So what is the written down value after charging depreciation? 25,617. Now this machine was sold. So this is the sale value 25,000. So you have incurred a loss of rupees 617. So this is the amount of loss 617 due to sale of M2. Now again on Now again on 1st March 2016, M3 was purchased. That is, on the same day, the M2 was sold. So I term this as M3, and on 1st March 2016, the cost of M3 was rupees 27,000. Now there is no more transaction during the year 2016. So on 31st December 2016, I charged depreciation at the rate 20%. So on M1, this will be 8,000. 40,000 into 20% will give you rupees 8,000. And on M3, this will be 27,000 into 20% into 10 by 12. Since the machine was purchased on 1st March 2016, so you have to charge depreciation for 10 months, and this will be rupees 4,500. So I am writing here 4,500. So written down value on 1st January 2017, the written down value for M1 will be 32,000, and for M3 this will be 22,500. Now I will prepare the ledger. So I am writing the ledger of machinery account. Machinery account. So on 1st January 2015, M1 was purchased, so to bank account 50,000. Again on 1st June 2015, to bank account 30,000. See, from the working, I am just putting it in the ledger. So on 31st December 2015, depreciation was charged by depreciation account. So you add up these two, 10,000 and 13,000, 3,500. So this will be 13,500. 13,500. So what will be the balancing figure here? Oh, sorry. Balancing figure will be by balance CD. This will be 66,500. So on 1st January 2016, this 66,500 will be brought down. So to balance BD, I am writing here 66,500. Now on 1st March 2016, okay, so another machine was purchased, so I can write it here safely, to bank account 27,000. Now the second machine that was sold on 1st March 2016, so you need to write first the amount of depreciation. So you can see here the amount of depreciation was rupees 883. On the same day, the second machine was sold for rupees 25,000. So what is the journal entry? Bank account debit to machinery account. And you have incurred a loss. So by PL account, this will be 617. So basically this is the written down value of M2, 26,500. So this 26,500, out of this 26,500, 883 is the amount of depreciation, 25,000 is the sale value of M2, and this is the amount of loss that you have to incur. So your journal entry is basically depreciation account debit, bank account debit, profit and loss account debit to machinery account. Now on 31st December 2016, depreciation was charged on M1 and M3. So what is the amount of depreciation on M1? This is 8,000, and on M3 is 4,500. So 12,500 is the amount of depreciation on M1 and M3. So by balance CD will be the written on value of M1 and M3. So this will be 54,500. 32,000 plus 22,500. You can see in the working 32,000 plus 22,500 is the written down value of M1 and M3. So both side total will be 93,500. So in one screen, I am presenting here. So on the left hand side, I have shown you the working. The entire working I have shown it to you. And on the right hand side, I have prepared the machinery account. Thank you. Thanks for watching the video. If you like the channel, then subscribe the channel to get regular updates